and welcome everyone to the Gatewood Wealth Solutions Weekly Market Insight. I'm John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, I'm glad to be here.
I'm glad to be here too. I'm just getting off a little bit of shoulder surgery, so I decided not to try to tie my tie with one hand. I don't think it would have come out too well.
Probably not. You need the clip-on.
You're right, you need the clip-ons. But a lot of things have been surging this week. We've had a surge in the market. We had a surge in COVID cases the last month. We've had a surge in debt with the U.S. We have lots to talk about.
A lot.
And we've heard that there is a president-elect. Vice President Biden is now President-elect Biden. And, of course, there's certain things that are still going on with the Trump administration trying to overturn the election.
Right.
But so where are we in terms of what we would do right now, assuming that, because we are assuming that Biden will be indeed elected on the 20th. So what will that mean for our portfolios?
Right. Well, technically, the president-elect happens on December 14th, whenever the Electoral College goes and is gone through the Senate process. It's still fine to call Biden president-elect. I'm by no means saying that, but that's the formal process.
That's official time.
Right, and that is what the clock that the Trump administration or the Trump legal team is currently battling is that December 14th post. Doesn't mean it has to be. That's just constitutionally the day that the electorals are supposed to post. There's all kinds of archaic laws and rules that are being used by the Trump legal team to try to have what is a two-part strategy. One, challenge the results of the election in the court system, as well as try to prevent enough electoral college members getting posted for that December 14th vote, because if they can't get 270 votes, then the election would go to the House of Representatives and they would vote on a delegate basis. The Republicans picked up a lot of seats in the House, and where the current delegate breakdown is 26. The new one would be 31 Republican-controlled states. So this is the strategy or the tactic. I would say it's a Hail Mary.
Right. So I mean, the time is definitely not on the side of the Trump administration.
No, but they have been making progress. That doesn't mean that they're going to achieve what they're seeking, but they now do have some of the court proceedings in Pennsylvania that were thrown out or reversed by the Supreme Court. Last night, the legal team, which is not just Trump legal team, there's also individual lawyers that are advocating for this. I mean, you can consider them their legal team because that's who they're advocating for, have now requested the Supreme Court to hear the case, and as well as Senator Ted Cruz has sent a letter to SCOTUS to try to get them to hear the case. There is a case in Michigan that is challenging the vote. Not Michigan, Wisconsin, I'm sorry. So Wisconsin has a component whenever you do a recount of the vote, there is an audit, and that's why the Trump administration did go ahead and pay for a partial recount in that state, is so that they could get in the audit. So now they're coming back after this recount, challenging about 221,000 votes within the state. There's also a hearing, I believe, tomorrow in Nevada, as well as the legislative approach where they're trying to get state legislators producing what do they call it? Basically a proposal in the state legislature. There was one in Pennsylvania. They ran out of time. They don't go in. So there's, like I said, it's all Hail Marys, but there are things going on, as well as a challenge by Sidney Powell. Remember, Release the Kraken lady. She has a lawsuit in Georgia where there is hearings that have been accepted. There was an injunction to take over and be able to physically view and run forensic analysis on the voting machines in Georgia. Remember, they have a January 5th election for the runoff from the Senate seats. So there's just a lot going on. But the probabilities they were rising over the last week whenever we look at the predictive model, but the session ending in Pennsylvania so that the state legislators were not able to get the proposal passed dropped the odds significantly yesterday whenever they
the issue is that most of the stuff is not really being reported on in the mainstream press, which is why it's important for us to stay on top of this, just because it's part of our risk management of the portfolios. I mean, we, on the investment committee, our belief on how we're positioning the portfolios is a Biden presidency.
Right.
But we always have to be prepared for the risk of something being different, which is why this is important to track, because that would make a major difference should this unlikely outcome actually happen.
Yes, and in the state legislator hearings that are going on, it's unfortunate that the media is not actually covering it and challenging
Well,
it
it's
because
kind of an interesting story to follow anyway. You know?
Well, being that they're not cross-examining the evidence and we're not actually seeing each part taken if you were to just listen to the hearings, I think a lot of people are going to be swayed by that, which is an issue because it's going to reduce the faith in the process if you're only listening to one side and no one is challenging the accusations that are being brought up in the hearings. So that's another issue, but that's going to be a later time to deal with, and most likely we'll have a President Biden when the scenario is over, but that means there's probably and I've seen polls suggesting up to 90% of Republicans do not think it was a fair election. That's going to be a difficult issue for the administration to get unity, and there's just a lot of problems that come out of this.
The big thing is going to be policy making now.
Yes.
Now you have people that are adversely opposed to each other, and how do you create policy? But that's one of the things that we're going to be on top of to make sure that we know how that might impact portfolios.
So, as you mentioned, we are still in that baseline scenario of a contested election. Most of our positions are assuming that a Biden presidency is in place, but as you said, we have to look at a low probability event as a possibility because it is a possibility.
Just like Brexit.
Just like Brexit.
Low possibility, but actually happened. But the dates are important. So
yes.
Like when we meet here next week, we'll have passed that first date. Do you want to remind us what those dates are?
That is whenever the Electoral College is supposed to have been selected. And remember, this is part of the two theater strategy of the Trump legal team is to prevent the states from posting their Electoral College or to post two slates so that there is confusion in the Senate on December 14th on who would be the clear winner for the Electoral College vote. So December 18th is whenever the panels are supposed to be selected and announced.
So we'll have some more clarity next week.
Who knows?
Yeah, who knows exactly anything in that. But so let's talk about the cabinet picks that Biden has been selecting, or at least told the public about so far, because that's going to impact policy going forward in the markets.
For the picks are more rumor at the moment. We are getting clarity pretty quickly on that, though. So next week, I bet there's a lot more faces up here that are known. But I think the biggest one is the Treasury Secretary, Janet Yellen. First time a female will be Treasury Secretary. And it's not the first time Janet Yellen has made history either as the first female. She was the first female chair of the Federal Reserve. She's coming with a lot of experience. We are familiar with her policies and her views. They are certainly left of the middle, but not dramatically. And she is a Democrat, so she's going to have a Keynesian view, which is not, in my opinion, really that different in the essence of the policy, which is we need to increase the money supply. We need to use monetary and fiscal policy to expand demand and stimulate the economy. So there's really not a fundamental difference in the approach. There is some concern from statements that she has made regarding diversity, equity, equality, and inclusion, Green New Deal, and other things of using monetary policy to push forward to push forward these agendas. I think that's the only caution is this more of the rhetoric and things that are being said right now, because remember, Biden has to appease not only the extreme left in his own political party, but the Republicans are also going to hold the likely, depending on the Georgia runoff, the Senate majority, so they have to confirm. So it's trying to balance both of those. So we don't know exactly what that policy really will look like and whether this is more just trying to provide an olive branch to the more extreme, I hate using that word, but the more left of the party.
Yeah, I think that the issue is, will she be used as a person to promote political agendas as opposed to being independent, which is what the Federal Reserve is supposed to do.
Well, she's not Federal Reserve. She's the Treasury Secretary,
right.
so she's part of the administration. Right. But I don't buy that the Federal Reserve is independent either.
Right.
These are essentially political positions. Obviously, they're going to have a political agenda.
Yes.
But then the actual policy implementation can often be very different from the words that are said at a podium.
So let's talk about the White House staff, because they're also going to be influential in policy making.
Yes, so I think the biggest to-do has been, I'm going to mispronounce her name, I'm sure, Neera Tanden. I've only read it, I haven't really heard somebody voice it. This is OMB, a very powerful position within the cabinet.
It's the Office of Management and Budget.
Right, so they're going to be setting priority, they're going to create who the basically what policies are getting brought up and the budget for President Biden's administration. So this is a very important position within the White House staff. The thing that is I think interesting is the left says she's too conservative and then the right says she's too liberal. So that probably means that there's much to do about nothing. And that she's really more of a moderate. She does have a lot of Twitter statements that people can point to. But if you're active and you're making statements, I mean, how many Twitter statements can you point to that President Trump, right? It's like if you have a social media platform and presence, there's always going to be something that somebody can point to.
But I mean, if we just compare the Biden administration to the Trump administration when it comes to monetary and fiscal policy, there's really not that much difference from the standpoint that they're both very accommodative. It's just that what part of the economy are the winners and the losers?
Yes,
I think that's the main difference.
It's what lobby groups are they needing to appease. And Wall Street, the tech companies really did put a lot of money into the Biden campaign. And they are expecting, and this is one of the issues with our governmental system, right? They're expecting some type of payoff based off that.
An investment banking or Wall Street wanting a payoff?
Same with tech, right? It's just that's one of the issues that we have.
Well, let's move on to the coronavirus, because that's still on everybody's mind.
The other member that we're paying attention to is not actually part of the staff. So they don't have to go through a congressional process. John Kerry, which we're very familiar with John Kerry. There's nothing to be concerned per se for John Kerry, but it is this position, the envoy for climate, which may indicate more of that Green New Deal component of the left. And this is where, and people can argue, and they do debate on the merits of this, but this is not a position, because it's a special envoy, that the Senate has any oversight. And it's getting back to the language that has some people concerned from Yellen, where it's the climate change and using policy to try to favor specific technologies over another.
Yeah, well, certainly, everybody wants to have a good climate and clean air and all of that, but we'll be getting more into the details of what that actually means as we get into
one of the things that whenever you look across countries, the wealthier you are, the more clean your environment will be, and that makes sense from just a standpoint of priority. When you're very destitute, you're not going to be as concerned about the clean air. You're concerned about food, shelter, etc. It is a component. If we were in a third world country, we would not be considering these because we couldn't afford them. So that is something that everyone is concerned about. It's all about what's the proper way of ensuring that we have a clean environment.
So let's move on to the coronavirus. So that's still with us.
And the timeline, we continue to go through the timeline. We're in the fourth quarter. Things are looking good here. The ISM manufacturing index is above 50, so that is showing expansion. We have this up here just because we want to finalize this timeline. You and I were discussing, what does 2021 look like?
Yes.
There's so many factors. We're in what a lot of historians call a turning. And the way that I think about it from a market is, if you have that kaleidoscope that you're looking at, you have the pattern, and you can see the pattern, it's beautiful or whatever. We're kind of in that turning of the kaleidoscope where all of a sudden things are changing and morphing, and we don't know what the pattern is going to be. So our best guess at the moment, considering all the stimulus, considering that we're getting some optimism from vaccines and dropping in cases, is that we think likely in 2021 we start to see some of that inflation show up in the price indexes.
So the cases have been surging, but now we actually, in the last week, have started to show a decline.
Yes.
Which I should believe would bring some optimism to people.
Yes. So we're seeing a reduction in tests. We're seeing a reduction in positive, the ratio of how many tests and how many positives. All of those are we noticed that a couple of two of these meetings, what our insight updates ago, that we started to see that decline, and we're now seeing that in the cases. It is an unusual way that the decline is happening on just that sharp
why
drop.
is that?
My guess is it's the data from Thanksgiving not being reported. It just caused a bigger drop. And that the other part that's unusual, and if we do a quick lag on here, is we've been watching and trying to line up, well, we see the cases rise, we see the daily deaths, and it's been several weeks. What's unusual is the drop in new cases and the drop in deaths happen simultaneously and with the same shape.
Right, because normally the whole idea is that there was a time lag between the cases and the deaths happening.
And we're trying to figure out why, because we think that might be something that's informative, and we've yet to be able to place our finger on it.
But how are we doing relative to let's say, the European Union and so on?
So last week, or 2 weeks ago, we had mentioned that the European Union looked like it had peaked because they started to really show the top and get a curve. And the U.S. had been a couple of weeks behind. We are seeing that drop in the European Union. You can clearly see the peak. Hopefully there isn't another peak that comes later. And now the U.S. is also starting to be basically in the position that the European Union was 2 weeks ago. We are seeing that peak in cases begin to drop.
But we finally have 3 vaccines now that are possible. How will that impact the market? I know we've seen some optimism as a result.
Yeah, so the vaccines and then the drop in cases, it's starting to create some optimism and people feeling like we're at the tail end of this, that we're kind of through the 7th inning of the coronavirus. Hopefully that is an accurate understanding. But then we also have these 3 vaccines. From my understanding, Pfizer is really the best when it comes to distribution because it has a long lifespan. We haven't been able to get into the AstraZeneca to get just the bullet points. We're not doctors. We can't dig in to really understand which one's best, but it looks like the Pfizer one. But having 3 options is good.
Yes, absolutely. Well, in addition to the surge in coronavirus cases, the other surge that's going to be more of a long-term issue is debt.
Yes.
Let's talk more about it, because this is something that we're going to be continuing to talk about in the future market insights, just because there is a long-term detrimental effect that this is going to have on the market, on the economy, and part of our job is going to be navigating through these headwinds that will eventually show up that can negatively impact portfolios, and how do we make sure that we can preserve assets and continue to grow them when those headwinds come?
Yes, so our concern, and has been our concern for quite some time prior to coronavirus, is just the way that the debt has been growing. And there's a lot of slides here. Don't spend too much time on this, but whenever we look at the U.S., it's been the governmental debt. Household debt has actually been decreasing or staying level. Non-financial debt has been dropping. It's been the debt taken on by governments. And we are now globally at 322% relative to the global GDP. So it's not just the U.S. that is having issues with debt. Ultimately, we do think this is inflationary. And then whenever you look at the U.S., because it's been the government that has been tapping the debt markets, oftentimes that's a crowding out effect, or at least is showing that the private market is not using as much leverage as the governmental market, which skews the resources towards governmental policy and other things. Now, that doesn't have to be a bad thing if it's infrastructure spending and other things that help the economy become more productive. It can still generate higher production, but that hasn't been the case. It's a lot of times, especially with the coronavirus in 2020, where we went from 3.3 trillion globally to now 10.3 trillion global debt expansion last year. So a significant jump.
That's enormous.
And a lot of that has just been trying to get money to individuals to stem the tide because they're not able to be productive, which means debt went up by an enormous amount, but production went down. So that ratio of debt.
So typically when you have debt, the whole idea is to have increased production. So
right.
we're really going the wrong
Which
way.
is good debt, right? Debt isn't wrong or bad.
Exactly. But then we also have the states are becoming strapped, and you have states like Illinois, which is borrowing just to make payroll.
Right, and we have this the moderates in the Senate and the House have put forth a stimulus bill at $908 billion trying to get that through, and one of the things that they're trying to do is help get money to the states because of the amount of unemployment benefits, and they're losing their population as we have people leaving because of the coronavirus and the work from anywhere. So there's a lot of headwinds here. But whether that stimulus package gets passed or not, there's been a workaround, and that is that states, specifically Illinois to this point, has now hit the Federal Reserve up for additional funding or loans to go around the market to get access to capital. And a lot of that is because of the unemployment benefits that they're having to pay. So the stimulus bill that is proposed would increase federal government aid in with a $300 a week unemployment benefit, as well as provide some relief to these states. Ultimately, that's a Band-Aid. It's not going to fix the problem, which is that these areas are they're indebted and they've leveraged themselves too far. And then you throw in the work from anywhere that we've talked about several times, where people no longer are needing to be in a geographical area to maintain their network. All of a sudden you can leave Chicago, you can leave San Francisco, you can leave New York, and that is the tax base is going to be going with them. So there's a lot of issues here.
Well, one of the things that you hear in the corporate markets are what you call zombie companies. So
yes.
Companies that are over leveraged, they don't have enough revenue to even cover the interest, but the rates are so low they keep borrowing money, but eventually they're going to die. I think the same thing is going to hold true with some states, wouldn't you believe?
Except that there's more political power to save the states and try to transfer that debt to the federal government, where businesses don't have the same type of power that the states do. And the Governmental Accountability Office actually put out a statement concerned about how a lot of these things are falling on the states. There isn't an easy solution. The most politically palatable is probably to figure out a way to transfer the debt to the federal government, but you're just moving the chairs on the Titanic at that point, right?
So let's talk about another topic, which is robotics.
Yes,
and what's
positive.
It's a positive thing.
Yes.
So we are actually getting better production because of automation.
Absolutely.
But does that mean that we're going to have fewer jobs?
Not necessarily. So one, if we look at the top left of this chart, it's showing where the U.S. is in its manufacturing relative to other countries. And we can see that there's a lot of room for the U.S. to add automation to bring their production capacity up. This is one of the reasons that we think the U.S. will do well over the next 10 years, despite whoever is the president. The facts on the ground, the way the economy is structured, we think that there's going to be a lot of automation, and productivity in the manufacturing industry is going to pick up. That does initially cause people to lose employment. Now, one of the issues whenever you keep interest rates low is you're essentially favoring capital investment over labor markets. And then you throw in the regulations of requiring health care costs or actually increasing the minimum wage. That makes labor less competitive against capital. So there are going to be hiccups. Long term, these things work out, right? The light bulb didn't cause anybody to lose employment, so yes, there were candlestick makers that were taken out and they didn't have to be employed, but think of all of the new jobs that were created because you can now have light and you could work in the night, you could do all kinds of things. So that production, the increase in production capacity actually makes employment long-term go up. There is always that painful move, and if you were a candlestick maker and that's what you knew, there are issues. And then there are safety nets that are trying to help offset that pain, but oftentimes those safety nets can help create a bigger imbalance. So it's trying to figure out how to do that appropriately. But what we are seeing is that that automation is coming. World Economic Forum put out a white paper, and they're saying that most businesses are going to be looking at automating a lot of tasks. So there's going to be this issue, or this tension through this probably over the next 10 years. And we saw it during the Depression when we went from an agrarian economy, and you had books like Steinbeck's Grape of Wrath, where people are no longer able to make a living doing subsistence farming because of the mass mechanization in farming, and that caused a lot of strife within society because of that tension.
I see up here on the top right of the picture that there's a KFC car with nobody driving it.
Yeah, so AI for these food trucks, this is in China. It's going to come here though, for sure, but they are having food trucks deliver. KFC's, they actually have a separate business in China because the demand is so high in China. But we also have Flippy, which is
Flippy.
a robot that is
Flippy the dog.
that is dealing with flipping burgers. White Castle is actually going to be putting this in to help them deal with the things. One of the things about White Castle is that it pays its employees very well relative to the industry that they're in. But what does that do? That says, well, individuals are more expensive, so then they are the ones that are starting to look at automation. And then the Boston Dynamics dog robot that I see a lot of YouTube videos on. It's really neat. It's actually out on some of the oil rigs for British Petroleum.
So the market has also surged.
Yes.
Let's talk about that. We reached new highs.
We did. We're getting a little bit.
Are we overpriced? Are we getting ready for a big drop, big downturn, correction?
The markets move up, down, and sideways. Yeah, I wouldn't be surprised to see a correction here. But we've been saying that we'll be in a trading range. We think that trading range is going to be sloping up, though, so over time. So yes, expect sell-offs. We're going to see that. There's a lot of noise. There's a lot. Does the stimulus bill get passed or whatever? But we are seeing positive traits, especially in the money supply. We're starting to see that uptick after having such substantial growth and then many weeks of a pullback. This is our third week of seeing the money supply grow. So that's giving us, we were cautiously optimistic and having some portfolio insurance. As these trends go up, we will be just optimistic and start to reduce our portfolio.
So assuming that this stimulus bill does go through, what will we expect for the money supply in that case?
Organically, the money supply, so it seems that banks, because there's less concern of prolonged lockdowns, and it looks like we're kind of through the worst of it. I don't even like using the word lockdown because it's just they're stringent, more stringent restrictions. People are still out and they're shopping. We don't see empty streets, so I think the lockdown is just too. The rhetoric is a little too hard there, and I want them all to go away. But the economy is still moving. Now, certainly small businesses like food, restaurants and gyms and other things are struggling, and people will say, well, they just need to take a pause. I don't think that's really being fair to their situation. It would be like me telling you, John, you just need to take a 30-minute pause on breathing.
Why do I have to pause? Why do you do that?
No. Right. So they certainly are struggling, these small businesses, and I don't think people are giving them the seriousness of what they're dealing with. These are what they've poured their life into, and they just can't afford to be closed.
Well, it's like the old saying, you don't want the cure to be worse than the disease, right? But so one of the other concerns that we've been talking about, and now continues to be that, is the declining value of the dollar.
Yes.
And what you're going to talk about is this unique dynamic with gold, with the price of gold, that we've seen something that we haven't seen before.
So
talk about that.
We've talked about what we think will be a downward trend in the dollar, that we're going back into that downward movement after being in a strong dollar for quite some time. We're back down to lows that we haven't seen since 2018.
So how are we viewing the different asset classes in our portfolios? Are our themes still the same? Are we still favoring the U.S.?
Our themes,
not favoring
yes, our themes
real
are
estate and those things?
We've once seen a value rotation, which caused us to make some changes to the portfolio, which we can go over here in a little bit. But we still think inflation risks are high, even though indexes are flat. If you look underneath the hood, it's agriculture, it's lumber, it's basic materials. It's not gold. It's not oil, though oil has been moving with the reopening theme. So there's the typical inflation hedges. You have to be very specific on those, and we are looking and examining positions because right now gold isn't working. We still want that inflation hedge. We're looking for things that are working, and we're doing the due diligence on what could we make, but we do like gold as a portfolio insurance component. So there are things, but ultimately the inflation risk is still a theme. The value rotation with this reopening where energy and banks and other things are moving up is, we think, just a rotation. Long term, we think the work from anywhere, the shop from anywhere is here to stay. It's a secular trend. We don't want to abandon technology. We found a fund, ARC, that got us both positive, but was avoiding that rotation sell-off, so we could stay in tech, and it was tech that was doing well. We still see the urban to suburban shift, so all of these are still in play. The declining dollar does give us some pause and want to go international. We would probably look at emerging markets. We probably will make some changes, especially in the bond portfolio. We just want to see the presidential election matter resolved before we take some of those long-term positions, because it should be resolved hopefully next week. I don't know how long this will go, but we do want to see that go out, because when we look at the risk reward, it still says to be cautious, because a Trump administration would change the value of these currencies substantially. So we're paying attention.
How about our relative strength in terms of the asset classes? They all seem to do very well.
Except gold, and gold is not doing well. We made changes out of the gold miners, and if we look at the broad basket of commodities, it's not that great of an alternative. But once again, if you go in there and you look at lumber, you look at agricultural products, all commodities are not acting the same. So we're still looking for that inflation hedge. We did get that sell signal a couple of weeks ago on our broad technology exposure, and made a change to ARC, which they have if you're familiar with Moore's Law, it's that the processing ability of a computer doubles every 18 months. Well, there's a Wright's Law, which is looking at the ability to produce versus what the costs are going down. And ARC uses this law to really price companies, and it's done a terrific job, and that has helped us regain some of the rotation loss.
Well, looks like we are out of time today in terms of our presentation. That's very informative, and we got a lot of interesting things we're going to be reporting on next week, especially because of the date with the Electoral College.
Yes.
And our broadcast will be the day right after the first deadline, so we'll have some more clarity, at least to whatever that means at that point, right?
It's clear as mud.
And of course, knowing President Trump, I'm sure he's going to do whatever he can to kind of stir up the pot here. But
yeah, I think of it like a chess match. He's lost his queen. He's not doing well, but each new move has a counter move. So we'll see how long the board he can stay on the board.
Well, thanks again for your presentation today. As always, it's incredibly informative. And I just want to remind our listeners that our market commentary is important, because we want to make sure that you have good information, so that 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 you can sift through the noise to make sure that we're making the right moves for your portfolio. But beyond the investments is really the planning. I mean, the planning is where it really starts. I mean, we can't just have an investment performance without having some plan to benchmark against that. Mm-hmm. Do you want to comment on that for a second?
Yes, it's not necessarily about what you're getting in the market relative to the benchmark. It's what do you need to achieve your goals and get the outcome that you want. And that's far more manageable than trying to beat benchmarks. It's just setting a need and being able to save and invest enough assuming a lower rate of return and still be able to achieve your outcome. That's where planning is, and that's really, we're trying to do our best to get a little bit more than what the market provides. But if you get what the market returns, that's all that matters on your outcome.
So if you haven't subscribed yet, there is a button here that you can push.
It's right underneath you.
And if you have questions that you'd like to talk to your lead advisor, the number to call is right here on the screen, which is 314-924-5100. So thanks again for joining in. We look forward to having you back next week.